hyper growth company, one that seems to be so overvalued in terms of price to earnings ratio. Maybe the price to earnings ratio is over 100, like in the case of Palantir, or maybe there's no earnings even to speak of for a company yet. It's still very young. There's no earnings. How do you go about valuing a company like this, especially one that is incredibly popular because it is growing so much? Whenever I look at Palantir's price to earnings ratio, it's obscene, 558. How can, it almost doesn't mean anything at all. So we have to use a different metric. Earnings is not the only important metric, but it is one of the most important metrics. In fact, this study by McKinsey and Company, where they looked at 2,200 large global companies, reveals the importance of monitoring both economic profit growth, very important, and revenue growth. So we have to take advantage of the revenue. We got to compare these hyper growth companies to other companies in terms of their price to sales ratio. That is the main strategy that I use when I'm trying to value a hyper growth company. So if we scroll down a bit, we can see the findings of this study. So they divided up these 2,200 companies into different quintiles in terms of profit growth and in terms of revenue growth. And as we can see, even if they only look at companies in the lowest quintile of profit growth, as they increase their revenue growth, the shareholder return increases. So this blue circle, this is a positive 8% return. And then if it's black, it's a loss. So companies that are in the lowest quintile of both earnings and revenue, of course, we would expect them to lose money. But then as we go up in either direction, shareholder returns do increase. And it's pretty equivalent here. I mean, if we stay in the lowest quintile of revenue growth, then when we get to the third quintile of economic profit, we're only seeing a 3% return, which is the same for profit growth in the lowest profit growth quintile. So anyway, there's not a huge difference between growing profits and growing earnings. Both are 100% valid ways to look at these companies. So let's use Palantir as our case study. That's what we'll start with. So I have made a spreadsheet like I do where the method here is pretty simple. It's pretty straightforward. I'm looking at the current price to sales ratio, and then I'm looking at the expected revenue growth, and I'm looking at a 5-year timeline. So whatever projected revenue Palantir is going to have in 5 years, if I can use those growth rates to estimate their revenue in 5 years, then I can also estimate their price to sales ratio in 5 years. And then if I know the price, or if I know the price to sales ratio and I know the sales, then I can calculate the share price at that time. Now, there's obviously going to be a range of possibilities. So I'm going to use, for sales growth, a range of high, medium, and low. Same for my target price to sales ratio. So one thing to keep in mind when we're trying to project a price to sales ratio, in general, price to sales ratios contract as a company grows more and more. So it makes sense for a company to have a super high price to sales ratio early on when it's growing a lot, because if a company is going to be growing a lot, people are willing to pay more now for fewer sales. Thus, we have a higher price to sales ratio. So let's actually let's look at NVIDIA. So NVIDIA is a great example of this. Whenever, or right before they came out into the data center world, most of NVIDIA's huge revenue gains are through data center sales. So selling their chips for data centers. So if we go back in time, this is their quarterly view, and we look at their market capitalization, they really started growing. And actually, let me go to the income statement here so we can see their revenue growth. Let me scroll back a bit. So their revenue growth, scrolling back a little bit okay. Actually, sorry, I'm going to look at this on the annual timeline. Let me get this together here. Oh, we're way too far back. Okay, so if we go back to 2020, so they actually lost revenue in 2020, and then, let's see, 2023 was relatively slow, but it was going from 2023 to 2024 when their revenue absolutely started popping off. So we see very little revenue growth in 2023, but there was a lot of projected revenue growth at this time. People knew that they were getting all these contracts with companies trying to build big data centers. So it wasn't a secret that NVIDIA was about to increase their revenue quite a bit. So in 2023, their price to sales ratio spiked because the market is willing to pay more for a small amount of sales now, because it's very likely to be lots of sales in the future. So let me turn to their ratios, and we're looking at 2023. So if I go to the ratios tab and we look at their price to sales ratio, and actually, yeah, and let's look at the quarterly after all. So if we go 2023 quarterly price to sales ratio, let's scroll back a bit, 35 right here. Boom. This is where in Q2 of 2024, in Q4 of 2023, it was as low as 18. And then as these reports started coming in, share price jumped, and we can see the share price started jumping right here. So the market cap going from Q4 of 2023 to Q1 of 2024 jumped by 47%, and then it jumped by 150% going from, I guess this is 1 year later, or a year prior. So huge jumps in share price and huge jumps in price to sales ratio as this growth is expected. But once the growth materializes, and once you start saturating a market and competitors come in, it becomes more and more difficult to continue growing at the same rate. Like if you have 1% of the pie and then you're trying to 10x your revenue, going from 1% to 10% of the market, that's possible, right? But if you want to 10x your revenue again, you have to go from 10% to 100% of the market. And that is way more difficult. That first 10x jump, doable. The second 10x, not so much. So in general, I guess the point I'm trying to make, a little bit long-winded here, but the point is price to sales ratios are going to contract over time. We can expect to see these price to sales ratios go down. So let's go back to the spreadsheet and see how this plays out for Palantir. So there's a couple things I have to enter in. I have to enter in their current number of shares outstanding. I have to enter in their current revenue. I'm entering in their current share price, and then their current rate of dilution. Because in 5 years, they're going to have, if they're issuing more shares of stock, there's going to be more shares in 6 years. And so I have to take that into account when I am calculating their shares price and their price to sales ratio, because the price to sales ratio is looking at their market cap. But if I want to know what the share price is going to be, I have to take the market cap and divide it by the number of shares. So the rate of dilution is also really important. So let's go back to Palantir and let's look at how much they are issuing new shares of stock, because it's important. So shares outstanding right here, diluted. So let's see. Yeah, and I did go to Palantir. So in 2022, they had 2,064, and then they diluted by 11%. They issued 11% more shares, and that next year they issued 6.5% more shares in the year after that. So it does seem like, and then if I go back a little bit more, they're issuing 70% and 96%. So big time dilution, but they have been slowing that process down. So for the purposes of this analysis, I'm going to give them credit for, did I say 6%? Yeah, we're going to assume 6% dilution rate. Now, let's look at the price to sales ratios first. Let's look at, well, no, I take it back. Let's look at their growth rate, their projected 5-year revenue growth rates, because I'm trying to project the share price in 5 years and then see what rate of return could I get if I hold that stock for 5 years from buying it today. So let's look at their price to sales ratio. So, and I'm on stockanalysis.com, Palantir. On the financials tab, if I go to ratios, I should see right here. So they are at 113. And Palantir is a company, their price to sales ratio has ballooned because they're starting to get lots of contracts. They are expected to grow their revenue a lot. So if we go to the statistics page, I can see their projected revenue growth over the next 5 years according to the analysts, which I like to rely on the analyst projections quite a bit here. So let's see, scrolling down, where is this? Analyst forecast, 5-year revenue growth forecast. The analysts are saying 40% on average revenue growth. So that's going to be my middle estimate right here. We're going to say 40%. Now, what's the top line possible growth if that's like what the average analysts are saying? And to find the range of analyst projections, I got to go to the forecast page, scroll down a bit. And right here we have revenue growth. So if this average is 40, to me, it looks like the top line revenue growth, the top line revenue growth, 56, 85, 60. Earlier, I went with 60 when I was looking at this initially. I think I'm going to stick with a 60% top line growth. That would be, and the way I look at this is, I feel like they're going to have a hard time maintaining 60% revenue growth. So I'm going to put that as unlikely but achievable, but it's going to be the top range, unlikely. So we got 60% in there revenue growth. The medium is 40%. The low, if we go back to the analysts, it looks like about 20% is what the lowest analysts are projecting. So that's a lot of revenue growth for Palantir. I mean, this is 40% every year for 5 years is insane. And if they hit that 40% revenue growth, then they're projected to be at $18.5 billion. They're currently at $3.5 billion. So this is almost a 6x increase if the average analyst is correct. So the next step is to see what kind of price to sales ratios we can expect. The way I try to estimate this is I go to the overview, and I always start by going to the industry that the company's in and comparing them to other companies in their industry. So here's my stock screener right here. I've got it filtered by software infrastructure. I'm also seeing price to sales ratio, and I'm filtering it for companies that have a revenue of over 100 million. So we're looking at more companies in the range of Palantir. And so Palantir's current revenue, it was $3.5 billion. So I got to go to the next page to see Palantir. But we can see, okay, so Palantir, 115 price to sales ratio, $3.4 billion. There's no companies out there that are really even close. Cloudflare is like relatively close. They have less revenue. And like I said earlier, the lower your revenue, the higher correlation there is with higher price to sales ratio. But as your revenue goes up, that correlation goes down. Price to sales ratios generally contract. So if Palantir is able to hit their average analyst projections over the next 5 years, then they would be projected to have $18.5 billion. So if I look at other companies that are making around $18 billion in this industry, I mean, these top earners right here, I'm seeing 13, 14, 14. It seems incredibly unlikely. CrowdStrike has a revenue of $4.5 billion, so a little bit higher revenue, but the price to sales is incredibly low. So if Palantir is able to hit these insane revenue numbers, and they're getting up here with Microsoft and Oracle and Block, are they really going to be able to maintain a price to sales ratio of over 100? So their price to sales ratio right now of 100, this is with 35, 40% growth rate. So in 5 years, they were able to, we'll say 5x their revenue. If in the next 5 years, they were able to 5x it again at this 40% revenue, now we're looking at $80 billion in revenue. So are they able to get to $80 billion? Now they're exceeding Oracle and still maintain a over 100 price to sales ratio. They're the only company in this industry that even has that ratio. In fact, I'm curious to see if I go to the entire stock market of companies that are having a revenue of over 1 billion, and then I filter this by price to sales ratio. This isn't just the one industry now. This is the entire stock market. There is nobody that's even close to Palantir in terms of price to sales ratio. So I personally, in 5 years, I do not see Palantir able to maintain a price to sales ratio of over 100. So I'm putting my assumption in at 60. 60 would still be 50% higher than the second highest price to sales ratio out there. And if they're maintaining 40%, or if they're exceeding expectations and they were able to average 60% and hit $36 billion in sales, it just doesn't seem likely that they can maintain such a ratio. So I think as an investor, it's prudent to factor in some price to sales ratio compression. My top line is 60. That would be, more than double anyone else that would be at that level. So if Palantir is able to exceed expectations, make it to 36 billion in revenue in 5 years, their nearest competition would be less than half that price to sales ratio. So that's already an insane ratio. So if they're able to hit that, then we're looking at a sales or a share price at that time of 640, which would represent a 30% share increase every year for 5 years. So that would be amazing if Palantir was able to hit the best of both worlds. 60% revenue growth, exceeding expectations by quite a bit, and maintaining a price to sales ratio that's more than double anybody in that neighborhood. That would be insane. So what I imagine a more reasonable price to sales ratio is 35. Now this would still be exceeding everybody in that neighborhood. So what do we say? 18 billion. If I look at the entire stock market and I'm looking at companies that are revenuing 18 billion, see, I don't know what the best way to do this is. If I just go page by page until we get to 18 billion. Okay. 18 billion. Price to sales ratios in this range. I mean, there's one guy, Intuit is 10. Lam Research Corporation is 8. There's just nobody that has such a crazy price to sales ratio. So I'm betting that the price to sales ratio drops off quite a bit. If the average case happens, 40% revenue growth, which is still crazy for every year for 5 years, 35% price to sales, then we're looking at only a 2.5% return every year for 5 years. And so in my mind, for Palantir to pan out as a good investment, they have to have in the neighborhood of 60% revenue growth. They need to far exceed their expectations, or they need to maintain their expectations and end up with a price to sales ratio that's still insanely high. And if let's say they hit 40% revenue growth and they have a price to sales of 60, then their share price would be 328. That's only a 14% return every year. And as my upside, it seems like a risky investment. I would want to see a more conservative price point today before I'm willing to bet on 40% revenue growth every year for 5 years and still maintaining a price to sales ratio that is not exceeded by anybody. So in my mind, Palantir is a bit overpriced. So let's move to the next company. The way I'm finding these companies, by the way, that I want to look at. So again, I'm trying to find companies that are extremely fast growing companies that either have very low profit or negative profit at this time. And I'm looking to see if I can find any companies that are undervalued on this price to sales ratio metric. So the way I'm doing this is I've got a filter here I'm looking at price to sales, I'm looking at revenue over $1 billion, and I'm filtering by earnings per share. I've got this filtered by highest price to sales ratios, and then I'm looking for companies that have either very low or negative earnings per share. Now, Palantir, of course, sits at the top of the list. Even though they are slightly profitable now, I decided to still use them because lately they're the quintessential hyper growth company, so I had to analyze them. But the next company that jumps out at me is Cloudflare. They have, price to sales ratio of 40. They're rivaling Palantir. Current revenue 1.8, and they are not profitable. So let's do Cloudflare next. Oh, and I'm spoiling as I'm scrolling down. I'm realizing I didn't have these in order. That's my bad. Here we go. Cloudflare. Alrighty, Cloudflare. So Cloudflare, they've got 345 million shares outstanding. Current revenue of 1.88 billion. The dilution rate is about 2%. Let's pull them up really quick. Cloudflare. Hey, Hokage, how's it going, man? Missed the start. What is the topic today? The topic is hyper growth companies that are not yet very profitable. They don't have a ton of free cash flow, so our normal valuation method is not going to be effective. However, a lot of these companies can still be undervalued when they have insane projected growth. If they're hitting that, if they're projected to hit tons of growth and then they hit those expectations, if they're undervalued for hitting those expectations, then I could be convinced to invest in one of these companies, even though they might have insane PE ratios. But if, for example, with Palantir, in order for their current share price to be justified, they have to well exceed their growth projections. So love the topic. Thanks. Appreciate it, man. So yeah, we're looking at price to sales ratio. We're looking at a 5-year timeline. Okay. If we know the current projected growth and we can estimate the price to sales ratio 5 years out, then it's just a simple algebraic equation. Price to sales divided or multiplied by the projected sales at that time would give us the price, or the market cap, in other words. And then factoring in their current rate of dilution, I can project how many shares outstanding they're likely to have at that time, divide that market cap by the number of shares, and get a rough share price. So the next company we're looking at is Cloudflare. Okay, so Cloudflare, let's look at their income statement. Okay, going down to the shares outstanding, they have been diluting by about 2% for the last couple years, and trailing 12 months about 2%. So I am giving them credit for a 2% dilution rate. Current share price, when I initially made this, was $2.19. I guess I should adjust it. Looks like they're at, we'll call it $2.14. Current share price, $2.14. Alrighty. So this is the column for projected sales growth every year for the next 5 years. So the highest, well, let's start with the average. The average analyst projections I have at 25%. Let me pull up Cloudflare, go to the statistics page, and then if I scroll down to the, let's see, where is the analyst forecast? Revenue growth forecast, analyst consensus is 26%. So that's what I've got in there. When I look at the range of analysts, I've got 37% per year for the top end, 15 for the bottom end. Now let's talk about how am I estimating these price to sales ratios right here. I've got a pretty big range, 10 to 40. If we go to Cloudflare, all right, their current price to sales ratio, what is it? Current price to sales is 40. So I've got their current price to sales at my top line. So I'm saying in 5 years, if they're hitting their growth metrics that they're projected to hit, they're not likely to have a higher price to sales ratio because of the reasons I listed earlier. And Hokage, if you didn't hear the rationale there, I'll go ahead and repeat it. So if I have 1% of the pie, 1% of the market, and I want to 10x my revenue, then I got to go from 1% of the market to 10% of the market. So 10xing my revenue when I'm small is doable, but if I want to 10x my revenue again, then I have to go from 10% of the market to 100% of the market. And that's just not as likely when if you have a situation where a company is making tons of money, other companies are going to see that, they're going to want to come in and compete. It's going to get more and more difficult. You're going to see price compression. You're going to see price to sales compression, basically, is what I'm saying. So it's unlikely that in 5 years, if Cloudflare becomes a $5 billion or a $9 billion a year revenue company, it's not likely that they're going to be able to continue growing at such a rate for as long as they are projected now, right? So they may be able to sustain 37% for the next 10 years now, but in 5 years from now, it's unlikely they're going to go another 10 years, right, at 37%. So I'm projecting some price to sales compression. So let's go to Cloudflare. I believe they're in the same industry as Palantir. We saw them, right? Same industry. Software infrastructure. So we pull up a list of software infrastructure companies, and we can see that on price to sales ratios, we got Palantir at the top. Let's filter this by revenue per year. So as we go up towards the top, and we already looked at this graph, CrowdStrike at $4 billion a year is at 25. They're the highest example. So let's say that Cloudflare is able to hit a price to sales ratio of 40. They're able to have the same ratio as CrowdStrike, even though they've exceeded their revenue. Let's put that at the top line. For the average, I'll put it at 25 because what did we see here? Okay, at 25, I'm seeing CrowdStrike right here, so they're at 4 billion. Cloudflare was at 40, sorry. But if they're going to be hitting $8 billion in revenue per year, I mean, there's just not any examples of of anybody close to 40. I have to scroll all the way down to see an example of 1.88 billion. That's Cloudflare at 40. Even if I keep scrolling down, if I'm looking for other companies that have that same price to sales ratio, even at lower and lower revenues, I'm just not seeing it. I'm not seeing it. Here's one at 14. There's just not that many good price to sales ratios once you start getting up into the multi-billion-dollar revenue range. So with these assumptions in mind, I'm putting 10 as the lowest. With these assumptions in mind, this looks a heck of a lot better than Palantir. So in the average case, if they're able to hit CrowdStrike level price to sales ratio at 5.5 billion, they're able to meet their expectations as far as the analyst growth projections, the revenue growth projections. That means their share price, assuming they also continue on the track of 2% dilution. So there's lots of assumptions here, but assuming they hit all of those, we're looking at an annual return of 12% if those are the facts 5 years from now. So in my mind, that is a lot more reasonable, a lot more achievable than Palantir. And we still have a really high upside here if they're able to maintain their price to sales ratio, which is possible. If they're exceeding their growth metrics and in 5 years from now, they're still projected to have that same growth going forward, maybe they will have the same price to sales ratio. It's possible. It's unlikely, but it's possible. So if they maintain 40, then we're looking at a 23% annual return at their projected growth rate if they perform as expected. So I'm seeing Cloudflare as a reasonable target. So the next company I want to look at, I've got a few that I want to look at here. Hokage, agree that is unsustainable. And I'm sure you explained how share price is calculated, but I missed it. Could you please explain the equation? Sure, no problem. Okay, so what we've got here, I'll go ahead and click on this one. So for this, and all 9 of these are just different combinations of these different sales growths and these different price to earnings. So we take so let me back up. So first, I calculate what is the revenue in 5 years, assuming this growth rate. So in 5 years, Palantir is going to have 36 billion in revenue if they grow their revenue by 60% per year every year. So we've got a revenue number and we've got a price to sales in 5 years. So to calculate the share price, we take the price to sales ratio, and this is the ratio of revenue to market cap. So I take the price to sales ratio, that's price divided by sales. I multiply it by the sales. Now we've got a price, which is the market cap, so I have to divide that by the number of shares that are going to be there in 5 years. Because remember, for Palantir, we're assuming 6% dilution, because that's what they've been doing. So they currently have 2,500 shares, but in 5 years, they're going to have roughly 3,380 shares. That gives us a share price. I hope that makes sense. And then this is just a combination of these 3 different scenarios. So 3 possibilities, 2 sets of 3 gives you 9 outcomes. The blue is the most conservative, so likely to exceed, and then the red is most aggressive, unlikely to exceed. And so I try to base my investment here on this average scenario. Okay, glad you get it. Nice. Okay, so moving along, let's go to Reddit. That's my next company that I'm looking at. So Reddit, they've been diluting at 10% per year. So they've got a little bit more dilution, 187 million shares. They're currently revenuing $1.6 billion and a share price of $266. So the average analyst projections as far as growth, 30%. The highest analysts are saying 60 and the lowest are saying 20. So with these assumptions in mind, Reddit is looking like a 40% maximum upside if they're able to hit 60% revenue growth, and that is insane revenue growth, and they're able to maintain a high price to sales ratio, which is 25. So let's dive into their price to sales. Let's look at that. Financials, balance sheet. We got to go to the ratios tab. Their price to sales ratio is currently 28. Reddit is in what industry are they in? They are in the internet content and information industry. So let's pull up that industry and let's compare them to other companies in that industry, specifically companies that have high price to sales ratios that are growing by quite a bit. Let's filter it by revenue. Let's look at the top revenue companies, and the highest price to sales ratio that I'm seeing at the top is Meta, and they are a massive company, tons of revenue. And one question that you might be wondering, why do some companies have like different price to sales ratios if they're kind of in a similar stage? Well, margin plays a big role in the price to sales ratio. Once you hit like a profitable, mature company, your price to sales ratio is going to depend on not only your future growth, but also your margins. Like how good is that revenue, basically? Like if your margins are very narrow, then your revenue isn't bringing in much profit. So a company like that with very narrow margins is going to bring in a much lower price to sales ratio, whereas a company that has high margins and high potential growth, they're going to bring in a higher price to sales ratio because people are willing to pay more for the same revenue. It makes sense, especially if there's high margins. So we were looking at Reddit. How far do we have to scroll down to find Reddit? What was their revenue again? It was like 1 point something billion. Here we are, Reddit. 28 price to sales ratio. If they're able to hit their growth metrics, let's say they hit their 30%, they're going to have $6 billion in revenue after 5 years. How likely is it that they're going to maintain a 28 price to sales ratio when they hit, in this column, $6 billion in revenue? So once we get up to Snapchat and Tencent and Baidu and Spotify, I mean, nobody's even in the double digits when they start getting up into these big revenue numbers. So yeah, here's Reddit right here. I looked right over it earlier. So yeah, so Reddit, 28. To me, it doesn't seem likely that they're going to be able to maintain such a ratio going forward. It's also helpful. Let's pull up the other spreadsheet again. Oops, what are we looking for? I want to add. Sometimes it's helpful to add revenue growth rate on here because seeing the revenue growth next to the price to sales can give you a little bit more color on a company as to like why they have such a high price to sales ratio. So let's do this really quick. And this is the entire stock market. Okay, forecast. I want to see just the revenue growth for next year. Boom. Okay. We got it filtered by price to sales ratio. Here's Reddit right here at the top. So they've got a 28 and they're projected to have 33% revenue growth. Broadcom and Nvidia, these are big companies. They also have 28 price to sales, and they also have revenue growth in the 30% range. So what does this tell us? If Reddit's able to maintain this 33% growth, even though they get up to a higher revenue number, there is still evidence that they could maintain that high price to sales ratio. It's unlikely that their price to sales ratio will increase, but it's possible. You know, we've got a company up here, Franco-Nevada Corporation. Well, no, their revenue is actually lower, sorry. ARM Holdings, and yeah, Palantir, of course, has a really high one. But okay, let's look at ARM Holdings, 4 billion, 39. So there is a chance that Reddit could increase their price to sales ratio, but that's just not the typical trend. So not horribly unlikely, but let's just say let's throw 20. Let's up this a bit. Let's throw 20 in here, and we'll throw 30 in here. So if Reddit is able to hit higher growth figures than what people thought, their price to sales might go up. If that's the case, we're looking at a really huge upside, 45% potential upside. But if their price to sales comes down to 20, even if we look at 28, like if they maintain their 30, and we can up this too to 33. If they maintain their 33% growth rate and they maintain their price to sales ratio, then we could see a 20% upside. That's if they perform as expected. So that's the kind of return that I like to see with a company. You know, when I was looking at Palantir, if they perform as expected, then, you know, we're looking at a return of 2%. If I put 60 down here, then we're looking at a return of 14%. So the argument here for a Palantir investor is they're going to be able to maintain their price to sales ratio. That's what's got to happen. They have to maintain or at least not drop below 60 for Palantir to be a good investment in 5 years. And that is where I get a little bit scared of Palantir. But with Reddit, a 28% or a price to sales ratio of 28, there is evidence that that's possible. There's other companies that make more annual revenue, and they're able to hit that. Paul K, I thought Reddit was done when it hit 198. Thanks for breaking it down. Been wondering why the price kept climbing. Yeah, it is. It's all about the projected growth. If it looks likely and reasonable that a company is going to grow, what do we say, 33% per year? I mean, that's insane. And at a certain point, the margins are going to start coming in, because Reddit, it's a software company. It's incredibly scalable. They don't have the same increased costs that a company like Amazon is going to have when Amazon's scaling. They're going to have a similar margin to something like Meta. So can we see that here? Market cap price to sales ratio. Profit margin. So the average profit margin in the internet content and information industry is 30%. So right now, Reddit's not super profitable, but as they become a mature company, they're going to start bringing in tons of profit if they're able to keep blowing up their revenue. So yeah, Reddit has a real strong chance to continue to return lots and lots to shareholders. So Reddit also looking really good. Just out of curiosity, let's say they hit 20. So I'm still getting over 10%. So if they drop their price to sales ratio down, if it contracts to 20, I still could see myself having an 11% return if they hit their growth metrics. And let's be clear, guys, this is still a big if right here. This 60%, 33%, 20%. If we go into a recession, companies may not want to advertise as much with Reddit. I understand they get a big chunk of their revenue from advertising. So there's a lot of unknowns, but if we just assume that they stay on track, then Reddit also looks like a reasonable investment. Okay. The next company I want to look at is Snowflake. So let's pull up Snowflake really quick. For those who are not familiar, Snowflake provides cloud-based data platform for various organizations in the United States and internationally. The company's platform includes AI Data Cloud, which enables customers to consolidate data, blah, blah, blah. Cloud AI company in the industry of software application. Here are all of the software application companies. Profit margins a little bit lower than the previous industry we were looking at, but 15% still really strong. And if I'm filtering these companies by revenue, where's Snow? I didn't miss it, did I? How far down do I have to go to find Snow? You know what? There's a smarter way to do that. Snow currently has a revenue of $4 billion. We way overshot Snow. I looked way over it. Here we go. Snowflake. Price to sales ratio of 17. If we look above, we see an 18 and a 19 and a 15 and a lot of price to sales under 10 in the single digits. So as we see an industry with lower profit margins, we see lower price to sales ratios as companies mature in that industry. So what is Snow at? We said 17. Current revenue, $4 billion. Let's look at the sheet. So the average analysts are saying 24% revenue growth. The top analysts are saying 35, and the low are 10 every year for 5 years. They're not diluting very much, only 1% dilution. At a 20 price to sales ratio, we got a 37% upside. At a 13 price to sales ratio, we've got a 16% upside. So Snow seems to be a lot more conservative than our previous companies that we were looking at. Let's look at the price to sales one more time with Snow. So they're at 17. I said conservatively if they drop to 13. So we've ServiceNow and Shopify, they're up here at 15, 16, 19. So Snow could get up there if they maintain their current trajectory. They could end up with a price to sales of 17 when they get there. And if they do, let's look at 17 in the middle. We see a 22% potential upside. So And I always like to see what it takes to get 10%. If I put in a price to sales ratio of 10, so now they're dropping down closer to the average, which I think is unlikely. It's unlikely that they drop down to 7 or 10. I think it's unlikely, according to the analysts at least, that they have 10% revenue growth. So even in the lowest cases, we're not seeing a huge downside, but in a reasonable, dang it. If they maintain and they do what the analysts project they're going to do, then we could see a potential 22% upside with a highest potential upside of 37. So Snow, in my mind at this time, is my top choice as far as these hyper growth companies that don't have earnings yet. I think Snow is priced pretty conservatively, especially with 24% revenue growth. It's not as much as Reddit. It's not as much as Palantir, but that's a lot of growth. It doesn't have near the downside. Palantir, see, and that's with the 60 in there. If we put the 35 back in, we put the 35 back in, it's negative 13, negative 12, negative 25. Pretty big downside. Even in the average cases here along this middle diagonal, it's really not much to speak of. And really, this is the diagonal that I'm looking at for kind of most likely scenario. You know, Reddit's got 16, 11, 9, and Snow has 11, 22, 12. So Snow, in my mind, is looking the best. More conservative growth outlook, more conservative price to sales ratios, less dilution. So far, I'm liking Snow. But the next company I want to look at is CrowdStrike. And this one was another one that was just at the top of the list as far as high growth companies. Let's see here. Where is CrowdStrike? Oh, I went way back. Let's go back to the beginning of this list. This is the, and we filter by price to sales. CrowdStrike right here, 25, negative earnings per share, so they are not making money. Paul K, I think it's conservative for Snow because of who they are up against: Microsoft, Azure Cloud, Amazon Warehouse, Oracle, etc. They are growing. I get their marketing emails at work. Yeah. So you're probably right. They're probably a little more conservatively priced because of who they're up against. That's a good point. Okay. CrowdStrike, 25 price to sales. Oh, I thought I had on one of these that I also added the growth rate. Here we go. Here's the growth rate. Where's CrowdStrike? Here we go. So CrowdStrike, comparing these to some of these other top growers, 21% revenue growth, not as high as Reddit, not as high as CrowdStrike, obviously not as high as Palantir, not as high as Cloudflare, but still really high revenue growth. Let's look at CrowdStrike next. Let's go to their financials. So they got 4.3 billion in revenue. As far as dilution goes, over the last 12 months, they've actually bought back some shares on net. In the last year, in 2024, they were basically flat. So what did I give them credit for? CrowdStrike, 0% dilution. So that is a nice bonus for them. But the average analyst put them at 22% revenue growth. They're currently at 25. So if we assume a little bit of price compression, that puts me at a 10% return with a positive upside of 30% per year. But like some of these other companies, we were looking at if they are able to maintain their analyst projections, if they're able to maintain their price to sales ratio, then the total annual return goes up to 21%. And if they're able to increase it a little bit, then we have a little bit of a higher upside. So that is possible. However, once again, 25, it's a high price to sales ratio. There's just, they would be required to hit $11.7 billion per year. How many companies hit $11.7 billion per year and have a price to sales of 25, especially in their industry and the software infrastructure? Let's look. Okay, CrowdStrike right here. So they're at 4. Let's filter this by revenue. Oh my gosh, I already forgot what I was looking at. Okay, we want to look at companies that have over 10 billion in revenue. If CrowdStrike is able to hit 11.7, that's what we're looking at. So if we're just looking at the ones just under 10, I'm seeing a price to sales of 14. The ones over 10 are certainly not getting up to 25. So it seems incredibly unlikely in my mind that CrowdStrike is able to keep hitting 25 price to sales ratios, especially once they get up into this upper echelon of revenue. Tommy Shelby, what's up? Glad you could join us. Hope you're doing well. So yeah, CrowdStrike, I think it's more likely we see a little bit of price to sales compression. Proud working in one of these from thumbnail. Hokage, you can address this comment at the end of the stream. Good news on PayPal. Okay, Google makes a strategic partnership with it. Oh, interesting. I haven't read the article. Did you do any updates to your spreadsheet? Yeah, I got some updates to the spreadsheet. I will have to re-upload that. And for people who have already downloaded my spreadsheet, at this time, I don't have a good way to like reissue it. So please send me an email and I will send it to you. Yeah, and Tommy Shelby's asking what article. I haven't seen the article, so I would be interested to see that as well. And maybe we can look it up. So yeah, CrowdStrike, keeping a 25 just doesn't seem likely to me. If I bump them down to 20, even 20 seems pretty high. It's a solid second pick right now, but I'm still leaning towards Snow personally. I think it just has a much better chance of hitting these metrics, more reasonable price to sales, whereas this requires such a high price to sales ratio for its industry. Doesn't seem likely. We already went over Cloudflare. The last company that I'm looking at, and then we can look at some of these other, I'll look at this article that you're talking about, Hokage, but the last company is CoreWeave. This one has been popping off lately. The average analyst put it at 50% revenue growth, which is just absolutely insane. Let me pull this up. So if I look at their stock chart, since May of 2025, they've increased in share price by 200%. So we're not catching this company at the bottom. This company's already gone up quite a bit. But when I go to the statistics, let's scroll down to the analyst projections for revenue. Where is it? Oh, did I pass it? Where is it? What the heck? Oh, it doesn't even have a 5-year projection, does it? Doesn't even have a 5-year projection. It's got a 3-year projection. And the 3-year projection is insane. So the average analysts actually have 180% for the next year, and then it starts to drop off. The highest analysts have over 100% revenue growth. So this company is tricky because the analysts are just all over the place. There's not like an analyst. The lowest analyst is putting it at 162% revenue growth. Okage, AI, data center booming. Maybe we should investigate some good energy suppliers. I think that's a great idea, honestly. That's a great idea. So yeah, CoreWeave is absolutely insane. Let's look at what I've done. This is, remember, this is a 5-year timeline. I've got the highest analyst at 100. I've got their price to sales messed up. Let's look at that really quick. What is their current price to sales? Ratios. Price to sales. They don't even list it on here. So, okay, I had to actually calculate it. Okay, their market cap is 62.6. Their revenue is 3.5. Yeah, 62.6 and 3.5. What does that come out to? So they have a price to sales of roughly 19. So let's, you know what, let's put 19 in the middle. Let's just make it a nice round 20. We'll put 30 at the top and we'll put 10 at the bottom. We'll just give it a quick range. When I go to their software infrastructure, we're very familiar with this one. We've been almost every single company we've looked at is in the software infrastructure. This is where all the growth is. We can see giving them credit for 20 is pretty good. Tommy Shelby, CoreWeave, Crusoe, Fluid Stack, all seeing 60% revenue at the moment. Yeah, maybe I should look at some of those as well. It's just crazy how everyone's throwing money in AI to be a leader. It's interesting, like, it's really hard to gauge. Are we in a bubble? Is all of this investment going to pay off? We'll see. At a time like this, I think keeping an eye on value when you're making an investment is more important than ever, because some of these companies are just pushed so far beyond even the analyst projections. And analyst projections are often on the high side. So if a company's valuation is even pushed past what makes sense for the analyst projections, then in my mind, that's just a major red flag. So yeah, giving him a 10 as the low end is pretty reasonable. I mean, that's pretty generous. So I'm happy with this range. With this in mind, we're seeing insane gains. So CoreWeave looks insane on paper. The question is, how reasonable is this growth? Now, if there was lots of analysts, if I had 5-year analyst projections and lots of high quality analysts weighing in on this company, then I would be more likely to trust these. But I mean, this is where, I don't have any expertise in the industry. I've got to lean on the professionals who put hours and hours and hours into analyzing these companies. And I don't feel confident doing that when I see how many they've got. 22 analysts, 12 are saying hold, 4 strong buy, 4 buy. I mean, there's a fair bit of analysts. If we filter it by the top analysts, the projections even get a little bit better. It's just a little bit spooky to me. It looks, maybe this would be a company to just put a small amount of money in because there's just such a high potential upside. I mean, if they're able to hit, I mean, even in the worst case scenario, if they're able to hit 25% revenue growth, I mean, that looks pretty good. It makes me wonder if I have some of these equations off. It looks like too good almost. No, it looks right. It looks right. CoreWeave is another one. Even though it's been popping off so much and the price to earnings is just crazy and the price to sales is crazy, I think it's a reasonable bet to make. A small percentage of your portfolio, it represents a really high possible upside. If you keep it to a small percentage of your portfolio, it's unlikely to hurt you too bad. So it's just crazy. However, yeah, agreed. CoreWeave is another one. I could see myself putting a small investment into CoreWeave. I'm curious, what do you guys think? CoreWeave, would you make a bet on CoreWeave or not? Once you see what the analysts are projecting, I mean, if they just hit 25% revenue growth and they end up with a price to sales of 10, then I'm still seeing an upside here. I mean, it makes me wonder if I've made a mistake on this somehow. Have I made a mistake? Let me just double check these cells really quick. Oh, so, I mean, it looks right. Something's got to be wrong here. When it IPO'd, I wanted to buy it because my friend wanted to buy CoreWeave. It was 34. Yep. That would have been nice. That would have been a good buy. Hindsight is 2020. I think I've made a mistake here. I think I fat fingered one of these. Something is wrong. No, I mean, there's nothing wrong, actually. It's just these growth rates are insane. That's what it is. It's just these growth rates are insane. And it's probably very unlikely. So is their current sales, let me just double check this. Their current revenue, I have at 3.5. I thought we checked this. Let me just double check my numbers here. Yeah, their current revenue, 3.5. If only we had a crystal ball, yeah. Their current revenue is 3.5 billion. if they increase their revenue by 25% per year for 5 years, yeah, the equation's right, then they're going to end up with 10 billion. So they're going to 3x their revenue. If they have 25% revenue growth, they're going to 3x in 5 years. If they have a price to sales of 10 at that time, yeah, 10 billion, 447,000. CoreWeave looks reasonable. Looks like a reasonable buy. I'm kind of talking myself into it the more I look at it. I was thinking I was going to go with Snow, but may have to call an audible here. Let me just double check. Oh, I remember what the big contentious. It was this 10% dilution. Let me show you all the dilution really quick. I threw 10% in there because I honestly didn't know what to do. This company has been diluting over the last 12 months by 55%. So that's a huge assumption right there. Like me putting them at 10% is actually a pretty big assumption. 55% dilution in the trailing 12 months. So let's play with that number a bit. Let's say they dilute at 20%. I mean, it doesn't change things by that much. My goodness. Current shares, 296 million. Is that accurate? Oh, wait. Yeah, financials. Yep, 296 million shares. CoreWeave looks good. I think the investment of the week is going to be CoreWeave. I mean, surely they're not going to continue to have 50% dilution. If they continue on their current trend at 50% dilution for the next 5 years, even though they could end up as a $10 billion revenue company, like I just don't see them needing the money from shareholders that bad. Like they should be able to fund their operations with 10 billion. Snow's going to be a slow and steady riser, Paul. I think I agree with you. Snow does look good for a small investment. CoreWeave also looks pretty good. Let me show you all the portfolio. We actually hit a pretty nice milestone on the portfolio, guys. I'm really excited to show you all here. Give me a sec. Let me pull it up. All right, here we go. Boom. We hit 5,000 in the YouTube public portfolio. My short-term goal was to get to 10,000, and that's putting in about $100 a week. Now, there's been some weeks where I did a couple companies, where I doubled down on 3 companies one week. There's been some weeks where I bought 2 companies. So it hasn't been 100% strict on the $100 per week. But in general, when we invest in a company, we invest $100, and on average, or I should say most often, we're investing in one company per week. We're up to $5,000. I'd like to get to 10,000. I'm gonna stay at about $100 per week, and then once we hit 10,000, I might revisit that. I might start putting a little bit more in per week. Maybe we do 200 per week once we get to 10,000, and so we can see the growth continue to accelerate. But let's see how we've been performing really quick. Okay, how do we do this again? Go to Invest, YouTube. Okay, and I can compare it to the popular benchmarks here. Should be able to. I don't see the button. I swear there's a button to compare to benchmarks. Here we go, view benchmark. Okay, our portfolio is in white, so we are currently outperforming the benchmarks. Year to date, the YouTube portfolio is up 21.5%. If we were invested in Total World, we'd be up 17. If we were in the core growth allocated iShares, we'd be up 12. And then I always like to add the S&P 500. I feel like that's that's the standard comparison. S&P is currently up 13. So we're still outperforming year to date. Love to see it. Want to keep that up. Investing in value companies most of the time. This week, obviously, is a little bit different. We're investing in a growth company. And yeah, I've decided I'm gonna be doing CoreWeave this week. I'm gonna go with the high risk, high reward, only $100, so a small percentage of the portfolio. Once again, I always like to point that out. Each investment is pretty small. So we've got 31 different companies that we're investing in. Paul K, been following along. Crocs has been a ride. Yes, it has. It's been up, it's been down. As you can see, I have quadrupled down on Crocs. We've put 400 into Crocs, or 420 actually. I don't know how the 20 got in. Maybe I had some dividends reinvested on accident from other companies. Crocs does not have a dividend, I don't believe. But yeah, we're down $60, 22%. Unfortunate, but I continue to look at it. I continue to monitor Crocs, especially on the spreadsheet. It still looks so undervalued. So I'm going to keep, every now and then, if it stays where it's at, I'm going to keep putting a little bit more money in. So let's look at it really quick. Okay. Oh, we got to get the analyst projections in there. Let's do a quick look at Crocs. We'll take over the Palantir. Okay. Crocs were up to 80 today, so we had a good day. The value is still there, Paul. I agree. I'm 100% with you on that. The value is still there. The analysts agree. The analyst consensus is a buy. The lowest analyst price target is 81, so the analysts are with us. Let's go to the revenue projections here. The revenue projections are modest. This tariff environment has been tough on Crocs, and that is probably why we've seen the share price get hit like we have. So there's only, unfortunately, 3 years of projections. I will estimate these next projections as, we'll say the upper end will be 5. We'll say the lower end will be 2. And then the lowest end, we'll say, will continue the trend of -5. Okay. And, the average analyst put it at -1, but Crocs' own shareholder guidance still had positive revenue growth this year. I believe that their own guidance was plus 1% for the year. So I think the analysts are undershooting a little bit, but what can you do? So with those projections in mind, we're seeing a huge upside with Crocs. 98% upside. Target share price is 159. That's assuming a 19% free cash flow margin. If we look at the past, that's taking the average over the last 5 years. So that's assuming their free cash flow margin doesn't get compressed. Maybe that's an assumption I should look at. In fact, if we take them down a peg, if we take them down 2%, because I think if I remember right, yeah, I adjust down a little bit, accounting for so cash acquisitions. They had a big acquisition in 2022, which I punish a little bit because it's kind of like a capital expenditure. It adds more future capital expenditures. So I punish for acquisitions a little bit, and I punish for stock-based compensation, and then I give a little bit back for R&D and capital expenditures, and the result is 17%. And that is mainly because they had a rough year in terms of free cash flow for 2022, and that is due to that big cash acquisition. So if I wanted to look a little bit more favorably, I could give them a credit for an average closer to 20, but as always, I like to stay conservative. I want to put in a story that I think Crocs can exceed, and then if there is still share price gains in that conservative story, then that's when I invest. So we'll take off 2%. Analyst low projection puts me at 74% upside on top of the 8.18% return. Okage says, I asked Gemini to do a discounted cash flow calculation on Crocs. It said 157 as the fair value. Okay, interesting. Looks like it's somewhere between my average and low, which I think that's a fair valuation right there. So sounds like Gemini did a decent job, at least compared to the way I do it. So yeah, I think Crocs is a killer company. And then also to point out on the Buffett supplement right here, I use Warren Buffett's red flags and green flags on the income statement, balance sheet, and cash flow statement. If one of these is highlighted green, then it's a green flag. Obviously, if it's highlighted red, it's a red flag. And yeah, Crocs does not have any red flags. I've gone over this before, but Warren Buffett looks for a gross margin over 40%. Yep, so that's good. He looks for R&D as low as possible, so 1% R&D is really good. Interest percentage interest expense as a percentage of operating income is 10%. So that's not quite a green flag. It has been in the past, but he wants to see under 10%. So we're like right on the edge, basically a green flag. Profit margin is really high, 23%. Excuse me. Long-term debt divided by profit. They have very low debt, so that's a green flag. Everything just looks so strong. Profit's been going up. However, their inventories have been trending down a bit, so not the best. Debt has been dropping off the last few years, and then CapEx is low, depreciation is low, plenty of liquidity. Operating cash flow goes up every year. Their number of shares outstanding goes down every year, so they're using their extra cash to buy back shares, meaning as long as they don't start dropping off in their revenue and dropping off in their margins, then even if they just stay flat, their earnings per share is going to continually go up because they're buying back shares. So love to see it. Yeah, I think Crocs is a great company in terms of value. I personally like their product a lot. I know they get clowned on a lot in the US, but overseas, people love Crocs. So, all right, guys, I think that's all I got for you today. Let's see. Was it Tommy Shelby or Paul that threw out a couple companies to look at? Tommy Shelby, CoreWeave, Crusoe, Fluid Stack. I'm gonna look into some of those and see how they look on this price to sales ratio, and maybe I'll feature one of them in a stream. Maybe we'll do a little bit of a dive into some of those, because yeah, 60% revenue gains, if that can be sustained, then that could be some major share price gains there, major capital gains. Okay. Well, if nobody has anything they want to throw out there, guys, thanks for tuning in. I appreciate y'all. Hope you enjoyed the stream. Every Wednesday, 7:30. That's the plan. We'll catch y'all next time. Oh, and don't forget, send me an email for the latest spreadsheet, because I've added, let me just actually say what I've added on here. The dashboard is nothing new. The Buffett supplement is nothing new. The price to sales ratio valuation tool, that's new. I've also got a video coming out, I think on Saturday, that talks, it's kind of what we did today on stream, but I'm making an actual video on it as well. Let's see here. What else do we have? We have the equity bond valuation spreadsheet. That's from our previous video. That's about it. So yeah, a couple new additions. So yeah, send me an email if you want the latest. If you're already, if you've already applied for it, then you got to send me an email. Paul, thanks for tuning in. See you next week. Okaje sent you the Gemini prompt. Thank you very much. I'll check it out. I'm curious to see how you did that. I've used, what did I use? I think I used ChatGPT in the past to do a discounted free cash flow calculation, and it did a pretty good job. But whenever I tried to bring in a whole bunch of, in the past I tried to bring in a bunch of spreadsheets and use some of that information, and it would hallucinate a little bit on me, and I would find some corrections. But overall, like, ChatGPT did a really good job. So maybe Gemini is just the better choice there. So sent you the email. Thank you. All right, guys. We'll catch you next time. Thanks for tuning in.